This is Jonathan Mickles with the Strategic Multifamily Investing Podcast, and I have with me today Mr. Daniel Woodford. How you doing, Daniel?
Good, Jonathan. How you doing?
I'm doing all right. Well, listen, thank you very much for getting with us. We had to reschedule like 4 or 5 times in order to get you. I'm glad we still were able to get on your busy calendar, and I'm looking forward to the conversation. So, to start right out, give me the name of your company and kind of how did you get into multifamily?
Yeah, so the name of my company is Mission Bay Capital Partners, and I really started, to be quite frank, I started in single families, and it was a kind of a transition from there. I was at the time in the military, getting ready to retire, and was looking for a way to kind of transition out of the military and then move into kind of the civilian world. And I just figured out that it was just one of those things where real estate was a thing that I keyed in on, and that's how I wanted to pursue it. Did single families in Baltimore, and probably about 3 or 4 years. Go ahead. I'm sorry.
Fix and flips in Baltimore?
Yeah, it was fix and flips. It was we were fix and hold for rentals, and wholesales, just the whole gamut of what individuals or investors do with single family.
So
And
you're
so
a part of some RIAs at the time as well, real estate investment associations?
not really. No, I've never really, I've never really been a part of those types of things. I would pop in every once in a while, but I never really joined up or anything. I guess I would say, but yeah, I mean, I was doing that, and there was a seminar that came into Baltimore about a single family seminar, and it was put on by Dave Lindahl. And for all of us that kind of know Dave Lindahl, he's a multifamily guru guy, and I didn't even know it at the time. I didn't know, and so at the end of the seminar was like, okay, so who wants to sign up for this single family platform? And I turned to a guy next to me and I said, hey, what do you think? And he said, well, if I'm going to spend the money, I'm going to go ahead and join the multifamily program. So I'm like, well, I've kind of done everything I could do here, really, in the single family space. We've kind of did a lot of transactions, and one of the things I realized was I just couldn't scale it. I couldn't control the value of the buildings once I got them done and put them on the market, and so it was a natural transition for us. And so we moved over into multifamily and joined that program.
How many units did you have single family?
We probably did about over a 3-year course. We probably did about 30 transactions, and then we're all fixing. Some were fix and flip, some were fix and hold, and some were were wholesales. So
Yeah, that Baltimore area is kind of tough because literally it's a block by block kind of comp. I remember working with an associate. Well, he was one of my clients, and he was working in Baltimore, and I think he was a friend of Michael Blanc, the multifamily, and Michael Blanc was doing something literally, I think, 2 blocks away or a block
yeah,
away,
yeah,
and my client won money, and I think Michael may have lost money at that time because it
yeah.
literally was or vice versa. It was literally a block by block situation.
Yeah, you definitely had to know it block by block, that's for sure. And
Yeah.
anyway, we were in Baltimore every weekend, all day long, just kind of scouring the various different neighborhoods, getting to know the areas and that kind of stuff. So yeah, it's definitely block by block.
Yeah, and for those who are listening, if you're a single family, if you're going to do some comps, right, you do, of course, the year, the number of bedrooms, the number of bathrooms, and if you're not in an urban city like Baltimore, say Washington D.C., you can go out a mile. But if you're in a city, you can go out maybe 3/10 of a mile, right? That's about 3 blocks. A block is about a tenth of a mile. But again, if you're in Baltimore, you know
Yeah,
Baltimore. So
that's
you
right.
moved over to Dave Lindahl. Did you join a coaching program or did you just do one of his courses?
Yeah, I joined the coaching program. We did a coaching program for a year. Joined up in it was in 2013, right when I was getting ready to retire from the military. And I
What
think I
branch were
started.
what
Go ahead.
branch
I'm
of
sorry. Air Force. Yeah, Air
Air
Force.
Force?
Yeah.
Okay, cool. So thank you for your service. But you were
Thank you.
about to
Appreciate it.
retire and went on in.
Yeah, about to retire, and in October of 2013 is when we actually started our coaching program. We actually closed a deal in December of that same year, so 2 or 3 months later. And so we were pretty excited. We gung ho, didn't know anything, hardly anything yet. We were just still learning, and luckily the market was such that it was actually, it was still on the upward tick even back then, and we ended up getting out of that one in about a year and a half. Made a good profit, a really good profit, and
Okay. So
mhm,
pause. There's a lot of questions here. How many
okay,
units was it in,
okay.
and where was it? Was it in Baltimore?
No, this was in Richmond. Yeah, it was in
Okay.
Richmond. So it was 40 units,
Cool.
and it was in Richmond. And at the time we had three investors.
Okay.
It
So you
was
syndicated it, or was this a JV?
it was a JV. Yeah.
Okay. Cool. Okay.
hmm So we did that as a JV. Made a good chunk of change there, and just did a 1031 exchange into our next project in Richmond, which was a 98 unit.
Oh, that's okay. So there's a lot of O's here because that's a lot. Because sometimes what happens when you have a team and you're working together, everybody may not necessarily want to 1031 together into another property. So some people want to cash out and get their money and move on. But you all must have been really tight in order to be able to say, we're going to just take all of this money, even though there's three of us, and then 1031 into another to defer taxes, right? It's not to not pay taxes, it's a tax deferral program. And so
Correct.
you tax deferred from 40 units into 98 units.
Yes.
Got
Yeah.
it. So what was your model? Were you doing value add, or you were looking at stabilization, or you were just doing better management? What was your
It's
what
kind of all of the above. I mean, really, it starts with the value add part of it. And then, for that 40 unit, it was some minor interior upgrades. It was doing some exterior upgrades, and and just management at the time. And really, we barely got around to, we didn't even get to the interior upgrades at that point. We bought the property at 27 a door, and then we ended up selling it for almost 35 a door, and we just moved on. And so, yeah, yeah,
so you left meat on the bone and moved on.
yeah, we left meat on the bone and moved on. Yeah.
Yeah,
So
that's good. So then let me ask you this question. You obviously had a great group of people, two other people that you were able to partner with. How did you find them? Did you find them through Dave Lindahl's program, or how did you find these other two people that you could JV with?
Well, one of the persons was he was my business partner, and it's still my business partners. We sat next to each other at the Pentagon, while I was there, and he was there too, obviously. And then it was just one other investor that we knew. So it was a close knit. I mean, close knit group. So
Got it. Got it. You all knew each other. Well, at least the two of you and business partner, and then
yeah.
the person is pretty simple to kind of get them together. Okay, cool.
No.
So then you got your 98, you got in at 27 a door, you sold it at 35 a door, made some money. Now you've got this 1031 thing. What did you guys do now?
Okay, well, let's back up. That was a 40 unit that we 1031 into the 98 that we bought for 27. We bought the 98 unit at 55 a door, and we ended
Okay.
up 3 years later selling that one for 72 or 73 a door. So again, the market was, and again, we only upgraded maybe 10 units of the entire building, and it's just the way the market was, and still the market is very tight. And so, Richmond is one of those markets that's really taken off, and it's been that way for several years now. So,
Yeah.
but yeah, that's how it was. And then, from there, now all of a sudden, people started taking us serious. We bought almost 100 unit there, and then the next project we immediately jumped into a 211 unit down in Georgia. And
Wow.
so, that's kind of how, the transition. The key, and one of the things that I like about, I mean, I like all of, several programs, and I advocate for several programs. But obviously, I came up with the Lindahl program. The other one I like is Michael Blanc, and both of them really focus on, okay, you got to get that first one under your belt, right? And once you get that first one under your belt, things start moving. You start getting a name out there. People start knowing who you are. from brokers to investors to those types of folks, and then all of a sudden things start snowballing. So the key, that's the key, I think.
That's a really good thing. So then my question is, right now, we're in, the second half of 2021, right? We've gone through 2020, the pandemic. Um, we were expecting the market to tank because the housing moratorium and, a lot of other, investors and, things like that may not be able to pay the multifamily notes, et cetera. But that hasn't been the case. There's still been, very high collections, somewhere in the 90s for most people that I understand. Not very much bad debt. Now, there have been a couple that I've seen that have gotten some bad debt, and it's in their T12s, right? And
Hmm.
they're probably going to sign, write those off. But how does someone break in to get their first deal now where there's so much competition? For example, in the Texas market, and this, and for most people who are, understand what's been going on, the process is normally you put an LOI in, and then after the LOI you get the PSA, and then after that then you do 1 to maybe 2% due diligence, EMD, and after your due diligence. But they're going hard, on the EMD's day one.
Hmm.
Earnest money deposit is EMD, and meaning generally there's a time between when you've signed and when you've done your due diligence, where the earnest money deposit is really gets transferred over to, if you will, the seller. But now those things get transferred day one. How does someone break into the market with all of that going on?
Yeah, I mean, so there's various different strategies. I'll just talk to the right now about the hard money day one. I mean, there's various different strategies that kind of mitigate that. So I don't want individuals to kind of be scared away because they hear that. Because what really happens is, okay, so even if you do go hard day one, you negotiate an access agreement so you can get on and start doing some of your due diligence, if not all of your due diligence immediately, right? And so while you're negotiating the contract, which could take 2 to 3 weeks or more often, you're in there doing your due diligence. So when you actually do go hard, you've already done a significant amount of your due diligence, and you feel comfortable to do that. And so that's one of the ways that we've gotten around it. I know a lot of people do it that way, but that's one of the strategies. So don't be afraid of money hard day one. I mean, yeah, you got to move a little faster. Yeah,
Mhm.
you've got to have your team in place. You've got to have your consultants ready to go. But there's ways to get around. You always got to, there's always going to be a way to get around
Right.
that.
And
So
and you, in that situation, you would go hard once you sign the purchase sale agreement or the
yeah.
PSA. But
Hmm.
if you've done your due diligence before you sign the
That's
PSA,
right.
you know what it is you're getting into. And if you find something that's really going to cause, say, maybe a water issue,
Hmm.
there's some underground pipes that have burst or whatever, when you get time to that PSA, either you negotiate or retrade, which you often don't want to do. But if you found something that's really, really crazy, and if the seller is unwilling to retrade at that point, then you don't have to sign the PSA.
Yeah, yeah, because as soon as we get an acceptance on an LOI, and you're absolutely right. As soon as we get an acceptance on an LOI, we're already bringing in our engineers, we're bringing in our contractors, our property management group, and we're doing our unit walks, and we're doing all of that stuff. And one of the main things we're looking at is the physical condition assessment. We come in and bring that in all right at day one. And so like one that we're working on right now, we did the exact same thing, and we found a structural issue. And before we signed the contract, they weren't happy about it. But before we signed the contract, we were able to negotiate a structural issue and said, hey, no, we need to, and here we are negotiating. We don't even have a signed contract yet, and that's never a good position for a seller to be in. But for us, it's a great position. But yeah, so I mean, there's ways to get around it, in other words. But you've got to be efficient.
And that's excellent. Thank you very much for addressing that issue of going hard day one. But as a newbie who's kind of out there, I mean, we at this point in time still do not have our first dealers yet. I mean, how what advice would you give to us? We've gone through the courses, we've gone through all the education, we're talking to people, we're finding and underwriting things, and they're not quite working out. as we initially intended. What are some strategies, some thoughts that you would give off the top of your head
Mhm.
for us to move forward?
Yeah, so one of the things that I quickly found out, and I'll go back to my single family days,
Sure.
and what I quickly found out is that I wanted to be the guy that people were bringing properties to, and not the guy that was always constantly looking for properties. And so the way I did that was I positioned myself as the money person, or mainly I positioned myself as the money person, even though I'm a military guy. I don't, military people aren't rich. They don't have a significant amount of capital, but I went and partnered with some people who did have capital. So we were able to, position ourselves as the money people. Now all of a sudden, I'm providing, capital to these guys. Okay, now we got people bringing me properties now. So you want to kind of position yourself that way. Also, that's what we kind of did in the multifamily spaces. I partnered or found individuals with capital, negotiated, not necessarily a formal partnership, but said, hey, if I find something, you want to partner with me on something like this. And these are guys that are out there that can either raise a significant amount of capital, or have capital, available that's liquid. And so, and that's what we did. And
Now,
mhm.
did you talk about equity up front in terms of how you would do those things? Because raising capital now, the law's a little bit different than say maybe 2013. Before you could bring on somebody who's a capital raiser, but now, someone who can bring equity must be able to do other things on the team.
Yeah.
What how are you I guess handling that? I mean,
Yeah, I'm not necessarily talking about just capital raising. I'm just talking about positioning yourself as, what you can do, what you can provide for individuals. I'm talking about, like myself, like this deal that the 40 unit. I mean, it was myself, it was my partner. We both could bring capital to the deal. We found another person, and then with that core group, we came together and said, we can go sponsor deals together. And so we promoted ourselves as, a key, as a sponsor at that point, because I had a collective of individuals that had capital, and we could position ourselves as sponsors. So when now it was all of a sudden, when you're a sponsor, you've got individuals that are out there finding deals that are actually bringing them to you so that you can sponsor. So that's one of the things that I did. One of the first things I did in the Dave Lindahl program was I went to what they call as a sponsorship event, where you can go there and find individuals like myself who can sponsor a deal for you, who can bring capital, bring earnest money deposit, that type of thing. And all of a sudden now you're in the game. You can go buy, you can find a building. Okay, that's great. Um, but the next year I came back as a sponsor because I saw the guys that were there had everybody at the event bringing them deals. And that's the position that you want to be in. You want to be in the position where people are bringing you deals, and not the guy that's just solely looking. So now
right.
75% of my deals are from individuals who want to do their first, second, or third deal. And 25% of our deals are from deals that we find ourselves with our own brokers. And so that's kind of how I got more deals coming my way.
So then, in terms of equity position, I think that was the thing that I was saying. Before you could say, okay, me, my partner, and somebody else, and we're JV in this deal. 33 and a third. Is what our positions are going to be. Do you work that out? Before you receive the deal, or you work that out after you get it? You just say, I have something.
No. So if we're talking about somebody who's bringing us a deal, I work it out deal by deal, because it really is it's deal specific, and it depends on, what exactly I'm required to do, what exactly that person can or cannot do. And so I always sit down with individuals, and I kind of have I do the Michael Blanc method, where he splits everything up and kind of says, okay, you do this part, I do this part, that's worth this amount of, so I kind of do it like that. And I try to, like I said, I sit down with each person, and we go through that, and we try to figure out where we sit.
Got it. Understood. Well, listen, thank you for that. And so for those who are listening, the Michael Blanc thing that he's talking about is, if you go to the syndicated deal analyzer that Michael gives us, a spreadsheet that helps you to analyze the deal. There is a tab that's there. I think it's called the returns tab, where you can scroll down and actually divvy out, if somebody brings capital, how much their percentage could potentially be. And it's a nice little waterfall in a way of being able to figure out equity positions, if you will, in a particular deal. Again, I don't get anything from this. Again, we both Daniel and I met at a Michael Blanc event several years ago, and so we're bullish on those tools. Now, in terms of analyzing those deals when they come to you, do you analyze them, or do you have a staff now that's analyzing those deals? How does that work out? I mean, I'm pretty sure you're quite busy these days.
Yeah, no, I don't necessarily, I don't analyze the deals anymore. I have an underwriter that does that now. And so, all the information goes to them. They put it together nice and fancy. And then that's when I come in and look at it.
Got it. Got it. Cool. So then as long as you have your underwriting under wraps, then you can go underwriter to underwriter, and then Daniel will step in.
Yeah.
How do they get in contact with you, if they have a deal that they want to bring to you, Daniel?
Mm-hmm. Yeah, I mean, just email's fine. Daniel at missionbaycp.com. That's fine.
Yeah.
Just reach out.
So hint, if you need money to do a deal and you think you have a deal, contact Daniel. You can contact me too. I mean, we've got things and but we're interviewing.
Okay. So let me turn it a little bit. Let me spin it a little bit.
Okay, there we go.
In your favor. Okay. If you have a deal to do, contact Jonathan, because he has a team of individuals that can sponsor your deal. Right?
This is true. This is true.
That's how I want you to present it from here on out. That way, now all of a sudden you just worked your way into the deal, right?
Absolutely. Thank you so much.
Now you're on the GP, and now you're getting credit for. Now you've got people bringing you deals. That's the goal.
And there have been a couple of situations already recently where I've been asked to be a part of GP sides, and so we are still working through that. But yes, please feel free to bring them to me. Thank you so much, Dan.
There you go.
He knows how to, you got a go giver spirit. That's really good.
There you go.
Well, you've done so well since 2013. And as I mentioned to you off camera, I've watched you for a couple of years and watched how you flow, and you're pretty under the radar, pretty low key. You don't even notice that he's in the room, but this man is quite successful in multifamily. And he's in the room with a bunch of other gurus, et cetera. And, every now and then somebody might say, "Oh, I know Daniel." And then he'll have a group of people, that's circling him, trying to get his attention. But your company has shifted a little bit recently from our conversations. Could you tell us about that?
Yeah, I mean, and really it was kind of facilitated by COVID, to be quite honest. I mean, we were right in the middle of closing a deal, which was our last deal. And that was, to be quite honest, it was March of 2020, right when everything was shutting down, and we almost completely lost the deal. Lenders were pulling out. And at the time, I'll just kind of go through that story real quick and tell you why we transitioned. But at the time, it was like a week before everything shut down in March. On a Monday, the lender called and said, "Hey, your loan is still on, but you might have to bring some money to the table with extra debt service. You had to bring a couple of months of debt service to the table as a reserve." I said, "Okay, well that's fine." And then on a Wednesday, it was another call. "Well, your deal almost got axed by the committee, but it's still on. Now you got to bring 6 months." And I'm like, "Okay, this is getting scary here." Yeah. And then the next day, well, all it was 1 week. The very next day, "Okay, Daniel, if you want this deal to go, you got to bring a full year's worth of debt service to the table." Like, oh gosh. So luckily, we were able to swing it. We were able to get it closed. But at that time, I was like, you know what? We got to step back a little bit. And it was just a perfect transition to step back. And we actually ended up hiring a consultant and to come in and look at our company to kind of help us do a couple of strategic things. One of them was to find an equity partner, another one was to help us ramp up our syndication efforts. And those were the two main things that we did was to really raise capital. So we had to come in and look at our company, kind of restructure things, put some initiatives on the books. And we came out of that actually with an equity partner that we believe is going to help us significantly grow. So we're pretty excited about that.
Pause. There's a couple of things through here. So, so did you wind up closing on the deal because you had to bring a year's worth of Uh, so you had that in reserve somewhere, or you had to bring on more people, you had to syndicate and raise some more money in order to bring that money in.
Yeah. So lessons learned over the course of all these deals that I was talking about. Always come in with a large reserve number, operational reserve. I always come in with an operational reserve because I don't, I like to have as little stress on my life as possible, you know. And
Hold
so
on.
we
So
actually,
what was your operating reserve though? What was
six
your
hundred thousand on this deal.
oh my gosh. Okay, so that was just for PI, principal and interest.
Well, so that was our reserve that we have programmed into our underwriting as okay. The management has $600,000 war chest that if
Right.
something happens, we can reach to it. It just so happens we had to bring a year's worth of debt service to the deal, and that was a little bit over 500,000. So
So
500,000 of that 600,000 went over to the lender, and now
okay.
all we have is like 92,000 for our war chest. I'm like, oh gosh, I don't know how well I'm going to sleep when everything is shutting down.
So how much a door was that? How much a door was that? That was
How,
like
how much was the purchase price of the
in
door?
terms of your operating reserve when you normally go. Some people generally do. I have heard, on average, the average monthly rent for the entire unit. Right? They take that, multiply that times the number of units, and they use that as an operating reserve. Is that how you calculate your operating reserve, or do you use a different formula?
I typically use it. I typically use it with regards to debt service. Certain
Okay.
number of months of debt service.
Okay.
And at that time, it was a year's worth of debt service. Luckily, and I don't know why. I mean, so what? And really, it's kind of a feel thing
Okay.
because what we do is obviously, as operators and as syndicators, we're going to set up the underwriting conservatively.
Okay.
And then one of the things we're going to add to even make it more conservative is that operational reserve because we want to make sure that, again, we can sleep at night. And so we're constantly playing with that number. That's one of the numbers that we're constantly playing with to get to the return numbers to investors. And so the higher you can make that number for us, well, the better. And luckily that worked out for us in that regard. So
Good, good. Now, the last I heard, and I think that it has changed, at the height of the pandemic, um, the reserves for the lender were 18 months of principal and interest if the purchase price was under 6 million, and a year of taxes and a year of insurance. So those numbers have decreased now, as I understand. So please check with whoever your mortgage underwriter is and do that. Daniel
yeah,
nor I are mortgage underwriters.
yeah,
Neither one of us is an attorney. Neither one of us is a financial advisor or an accountant.
yeah.
So just understand this information is, we're just giving this to you as we're seeing it right now. That's great, man. So now in terms of an equity partner, you going out and reaching out for an equity partner, you had equity partners. I mean, you were doing syndications. So you had that group of people that we just talked about earlier who could help you fund your deals. Describe, I don't want you to give away your secret sauce, but describe to us a little bit more about who this equity partner was.
Yeah, I mean, so we kind of felt that it would be good to have multiple paths to raise capital. And one of them obviously is doing the syndication, which yeah, you're right. We have a good kind of database of investors in that regard. But we also wanted to have the capability to go to a larger deal if we wanted to. That's something that's kind of more difficult to raise with a syndication. You want to have a single check writer or maybe one or two check writers. And so we kind of searched out for somebody that fit our kind of company and our kind of structure and so that's kind of what we did. We have an equity partner that's a kind of a single check writer.
Good, good, good. That works. That works. And then you put in some additional syndication efforts. You beef that up a little bit more. Can you share what system you're using to manage all of your CRM, if you will?
Yeah. So Christine Jefferson, my business partner, handles a lot of that. If I say it wrong, because I know that was part of the consulting effort also was to kind of set us up in that regard, the technology part of it. And I think we use Active Campaign.
Okay.
I'm pretty sure we use Active Campaign and we use
Yeah. Yeah.
Asana. So mainly
Okay.
Active Campaign. Yeah.
Yeah. Asana is probably more for your project management, and
Yeah.
then Campaign is more of your CRM for people. So
Yes,
yeah,
yes.
I've used both of them. I also, from a project management perspective, I use Trello uh,
Mm-hmm.
as one of my project management tools. Trello is free.
Mm-hmm.
Asana is free. So you can get those tools if you need them for project management. I probably should start doing a bunch of videos on stuff, technology stuff. I just
Yeah.
recently did a bunch of technology stuff with another organization, and maybe we'll reveal that in a little bit. Um, yeah, and we'll just put something out there. I'm thinking about adding that to my platform. Some of the technology that we've been able to do. That's my background is technology.
Mm-hmm. Okay. Yeah. Yeah. Perfect.
So now that you guys have been repositioned, you're in place, you've got your single check writer, you've got your syndication stuff, beefed up and whatever. How many units do you guys have under management, and what dollar amount does that represent for you guys?
Yeah, so we've sold one or two so far, but we had about, as of the beginning of this year, we had, right almost 1,500 doors, and so yeah, and about 150 million dollars in assets.
It's pretty steep, everyone.
Okay.
Pretty steep. Thank you so much, Daniel.
Okay.
So where are you going now? I mean, you've sold a couple already this year. Um, Before I ask you yeah, let me ask where you're going, because I got other questions I want to ask you too. So where are you going now? What's the next goal? Are you trying to get back to 1,500 doors, or you want to bust through 2,000? Where are you going now?
Yeah, I don't know if we have a kind of a number of units, kind of a goal. But certainly we want to do better than we did, than we did last year, and just kind of keep improving. I think what we came out of our initiative, our initiatives out of our company review was, we wanted to do maybe $60 million in
Okay.
deals this year, and so that's kind of maybe the number that we're looking at. I think we're going to go. I think we're going. I personally want to go higher than that. That was just kind of a baseline, but yeah, I'd like to go higher. So
And so what markets are you tracking right now?
we've always been in the Mid-Atlantic. We've always been kind of in the Southeast. We're in the Carolinas, Georgia. Just now looking into some markets in Florida, um, and Texas.
Got it. So people have been, kind of thinking, well, I won't call names in the industry, but people have been thinking about, there may be some doom and gloom because the moratorium is going to be lifted soon. What are your thoughts on that? I mean, do you think that we're going for a crash and a correction? Because, cap rates have been, heavily compressed in a lot of the markets out there. I remember back in 2017, 2018, where you can get a, C-class multifamily unit for an 8 cap. Good luck trying to find, even half that almost
Yeah.
for a C class. So what are your thoughts?
Yeah, I mean, it's kind of interesting, just depending on who you're talking to in the industry. But in many regards, it feels like we're at the top, obviously, in many markets, across the nation. But at the same time, there's a shortage of affordable housing, out there, and the kind of the dynamics, or the kind of the underlying facets of, I'm sorry,
Okay.
of multifamily, the dynamics there are still strong, and so
Mm,
there could be a scenario where multifamily kind of is continues to move forward, even continues to move forward without having a correction for a while. Now, who knows? I mean, I have no idea exactly how long, but yeah, I've heard that being spoken. So
it would appear that there is a glut of evictions coming from my perspective, from what I've been reading and researching. However, it seems like that glut of evictions that happens, there is a group of other people that are poised to kind of fill those gaps. So
yeah, I mean, if I were to just go by what we're seeing in our own portfolio, we're not having a significant issue with keeping it leased up. Um, and to be quite honest, like you said at the beginning, we're not having a significant issue with collections, other than that one property that almost didn't get done in March of last year. But even in that property, we're still sitting over 90% collections, and so We're not having a huge challenge there. I mean, in some markets, we're even pushing rents, and so
Yeah,
I'm not gonna say we're not having a huge challenge because obviously it's challenging out there. I'm just saying that we haven't had a significant impact with regards to finding tenants, finding tenants to lease up the properties.
got it. Well, this has been a very good interview. Again, one I've been waiting for, as I mentioned before. You have been noticed, even though you're quiet and in the background. And great to hear that you guys were able to reposition successfully, even in the midst of a pandemic. So what I always ask my my people at the end of the conversation is, give us the boot. What is the one or two things? What kind of advice would you give us or the listeners to be able to spur them on to do something in multifamily or to do better in multifamily?
Yeah. Yeah. I would say, I kind of alluded to it at the beginning, and that is, and I hate to use a cliche, but you kind of got to fake it until you make it. And I kind of did that. I really did. Like I said, I positioned myself with this. I mean, I did have what I talked about, but it may not have been such a cohesive group at the time. But
Yeah,
I had capital that I could turn to and that kind of thing. And I had a little bit myself, but that's neither here nor there. But it really is the capital. So it's position yourself to if you're really looking for a deal. Don't think that you have to do it on your own. It's position yourself with a team to kind of have multiple people bringing you deals so that you can kind of you can kind of look through multiple deals at a time.
excellent. Well, listen, Daniel, again, thank you again for your time. And if there's anything that we can do here at Red Boot to help your company, or please feel free to reach out at any given time.
Okay, appreciate it, Jonathan. Thank you.
Thank you.